Well, there seems to be an awful lot of doom and apocalypse out there today in all of the forecasts. Europe potentially tearing itself apart, the euro no longer existing. Uprisings and the specter of nuclear war in the Middle East. The economic abyss if we go over the fiscal cliff. You can see every day on CNBC they have the countdown clock to the end of or the potential end of time with the fiscal cliff. But I want to focus on a much more long-term focus, a benchmark that has a much longer-term track record, actually 5 millennia. Just last month, I was down in Mexico City and gave a talk at the National Archaeological Museum, which is some of the greatest treasures of the ancient world there. And perhaps the most prized and most famous there is the Mayan calendar. Some say it foretells the end of the world on the 21st of this month. 12/21/12. Well, many websites also have a countdown to that. 16 days, 14 hours, and 37 minutes and 29 seconds. And not that I've really been keeping track very closely. Well, my outlook for the next year may be bleak, but it's not as bleak as the Mayans. Not only do I believe we will survive to 2013, we will have positive growth. But let's not start popping the champagne corks quite yet. As you may recall, last year, I used this phrase, the sideways slide, to characterize where I thought the U.S. economy was going to be going in 2012. And unfortunately, I think that was dead right. Now, also, unfortunately, for the first time in a while, we no longer have the scorecards where you could see my predictions. And so finally, I get it right, and we don't have the evidence here anymore. But that's fine. You can go back and look at the card from last year. It's still on the web. So I said we'd have growth in sort of the low 2s, 2 to 2.5%, which is roughly what we've had. But that wouldn't be sufficient to really chip away at the unemployment rate. We certainly have seen positive private sector job growth, which is exactly what I thought we would see, but not enough to really chip away at that unemployment rate. So the unemployment rate has stubbornly been just a few tenths of a percentage away from 8% for more than a year. And unfortunately, I don't see the prospect for dramatic improvement going forward. I don't see double dip, as I had said last year, but I don't see the prospects for real takeoff either. I think we're likely to slide along at 2 to 2.5% with this continued modest growth. I think we'll continue to have private sector job growth, but it's not going to be sufficient to put a dramatic dent in the unemployment rate. I think the unemployment rate is likely to come down, but not dramatically. Now, one of the fortunate things in the forecast that I had made last year, and I'm carrying over to this year, is inflation seems to be reasonably well contained in the short and intermediate run. If you look at inflation expectations as well as actual inflation, it seems to be quite well anchored, quite well contained. The Fed actually last January, just soon after this event last year, put out an inflation target or an inflation goal, as they said, of 2%. And they've actually largely been undershooting that target rather than overshooting that target. And given my view of continued weakness in the labor market, I don't see a lot of price pressure coming in. Now, why no real takeoff, but also why no double dip? The housing market. We've seen good stabilization of the housing market. I think the Federal Reserve's policies that have really been laser focused on trying to make sure that that market doesn't go over the cliff have started to see some payoffs this year. If you look at something like the Case-Shiller Index, which has an index of housing prices for the top 20 markets around the country, 18 of those 20 markets have seen positive price appreciation over the last year. Unfortunately, Chicago is in the minority of one of the two that has seen price depreciation, although fortunately not much, and it seems to be turning the corner, but not dramatic strength here yet. That's something that's very important because people's confidence, a lot of people's wealth, are tied up with their housing, so stabilization in that market is important to make sure we don't have the double dip, but I don't see a dramatic bounce back coming in most markets, and so that'll provide the foundation for growth, but not for a strong takeoff. We've been seeing deleveraging continue. And there are fewer foreclosures coming onto the market. They've been very slow to work out, but fewer now coming onto the market. Banks are continuing to hold astonishing amounts of excess reserves. When I got to the Fed in 2006, banks held on the order of maybe tens of billions of dollars of excess reserves. They now have more than 1.5 trillion 100 times the excess reserves, because they're concerned about doomsday repeating itself, about some sort of crisis coming, as well as they don't see as many good lending opportunities, and so they are hoarding cash, much as many firms around the world are also hoarding cash. But we're starting to see a bit of an increase in lending, and we're starting to see a bit of a relaxation of the real incredible tightening of lending standards that had gone on. Some tightening was necessary, but now we're starting to see a slight move towards normalization. Again, foundation for continued growth, but not for takeoff. So a couple of things I think really hold us back, and one of those has to do with why I think income growth and GDP growth will be a bit sluggish, despite gradual declines in the unemployment rate. Normally, we would think, well, fewer people are unemployed, so you're going to see a lot more income growth. But because of demographics with our aging population, because of discouraged workers leaving the workforce, and many people who have fewer skills because they've been unemployed for so long, not really being able to be engaged as well in the workforce as before, we're seeing fewer people working for any given level of unemployment rate. So the employment population ratio, as well as the labor force participation rate, have come down just astonishingly rapidly since the onset of the crisis. From 2007, we've seen a 5 percentage point drop in the employment to population ratio and a 3 percentage point drop in the labor force participation rate to about 63%. So even as unemployment rate comes down, there are going to be fewer people working for an equivalent unemployment rate. And so you're just going to see the same kind of growth, because growth ultimately is the number of hours worked and the output per hour, the productivity of those hours. And I'm going to come back to productivity in a minute, because I think that's another thing that's holding us down, and that's related to policy uncertainty. Steve Davis, who's now in the Dean's office with Sunil, has done some pioneering work on the importance of uncertainty for holding back consumption, in particular, holding back investment. And one very important aspect of investment is employment, because as you well know, as business people, employment is not a short-term investment, it's a long-term investment. You spend a lot of time trying to find the right people, train the staff, and you want to try to retain them. And people have been reluctant to do that because of a lot of uncertainties. One, obviously, the policy uncertainty in Europe. I think Carl is going to focus more on that. It may be that the Mayan calendar will be right, that we will reach doomsday before they finally resolve things, but I'll leave that to Carl to tell us. We have uncertainty about regulation, particularly related to healthcare. And that is legal uncertainty related to Supreme Court decisions, as well as just uncertainty on implementation of the law. And then some obviously very important fiscal uncertainty in both the short and the long run. The U.S. is not on a sustainable fiscal path, and the U.S. election has not helped to clarify things, unfortunately. Well, how can the U.S. boost growth? How can we actually try to improve that piece that we really can have an impact on, which is productivity growth? Well, taking out some of the burden of uncertainty to improve investment and change the structure of the tax system to try to be more pro-growth. And I think that's one of the key elements of reform, is to think about using the tax system not just as a revenue-raising device, but also something that reduces distortions and tries to promote entrepreneurship, promote growth. And I think the broad outlines were there from the Simpson-Bowles bipartisan commission that both parties ran from, unfortunately, and hopefully they'll be embracing more of them now, to try to reduce rates which distort both investment and labor supply, and try to reduce the number of loopholes, so broaden the base. Because now a lot of people make investments not based on what's a good economic payoff, but what's good ex post tax return, and that's not the best way to allocate investment. But another piece is that we've got to really have sort of a root and branch rethinking of government expenditures. So I think there's this false debate on austerity versus stimulus. That's talking these big picture terms. We need more, we need less. That doesn't make sense. As any business person knows, what you want to do is think about bang per buck. So there's some expenditures that are certainly worthwhile. I think I grew up in the New Jersey, New York area. There's a bridge that's just north of the George Washington Bridge, the Tappan Zee Bridge, which is a major conduit across the Hudson. It's a total disaster, always under repair, always in problems, slowing down traffic. That's a real bottleneck. That might be worthwhile investment. But the stimulus package included the high-speed rail train between that important bottleneck in Duluth to Minneapolis. is this really where we need to be having expenditure? We need to think about where we're going to get the most bang per buck, where's expenditure going to be productive, and that's how we should be thinking about the debate, not just more austerity or more stimulus. Monetary policy, obviously something that's very much on people's minds and very important going forward. We have a meeting coming up next week where the Fed has to decide whether the current program that it has, Operation Twist, of selling off short-term securities, buying long-term securities, will maintain itself. I think they're likely to phase that program out, but buy more securities. The Fed has still been focused on the mortgage market. I think they're likely to buy, continue the program they have of buying mortgage-backed securities and expand that to make up for it fading out of the Operation Twist. And the balance sheet is now $3 trillion. When I got to the Fed, it was about $800 billion. So it's the Fed has, at least its balance sheet, has expanded and done well during the crisis. That's an unfortunate thing, but I think that it had to do that. But I think it was very fortunate to avoid a repeat of the Great Depression, the devastating deflation that came. But now monetary policy is trying to do more, not just provide the foundation for growth and avoid deflation, but really act as the catalyst for investment and growth. Now, bringing interest rates down, real rates down in particular, helps to stimulate investment because it reduces hurdle rates. But given the burdens of uncertainties that I described, and so the doom and potential apocalypse, that's not going to be able to do it alone. It's just not sufficient. So I think the effectiveness of monetary policy and really getting us back on track is going to wane, or has waned a bit. I think it's important that the Fed still provide a lot of support, but we're going to need action on these other fronts to really go forward. I think one of the key things that they're going to do is do so-called open mouth operations rather than open market operations. They've been focusing a lot on how they speak about things, on the clarity of their communication strategy, setting an explicit inflation target, talking about when they're going to keep rates low until, and even more so, the next step is that they're going to start thinking about being explicit about the conditions under which they would likely keep rates low. That might mean talking about a goal or a level for a trigger level for unemployment or other variables like that. But that's a real challenge because the unemployment rate is a rough indicator of how the labor markets are doing, but it's not always an accurate indicator. This summer, the unemployment rate fell by 2 or 0.3% in the middle of the summer, but it was for the wrong reasons. As I said, the labor force is shrinking, so the unemployment rate are the number of people working relative to the number of people who are working and looking for work. But if a lot of people become discouraged and exit, well, the unemployment rate may seem to go down because more people may seem to be employed. So we have to be very careful about what indicators we use. I want to just spend a couple of minutes on the world's second largest economy, China. Sunil and I just came back from a great set of meetings in China at the annual conference of Caijin, the equivalent of the Economist magazine, and we met with a variety of people, the premier to be, as well as the head of the Securities Regulatory Commission, who's been often touted to be the new head of the central bank. And during his formal lecture, Sunil leaned over to me, took off the translation headphones and said, "Is this Milton Friedman reincarnated?" It was amazing. The man talked about there's no such thing as a free lunch, how we need open competitive markets in banking and finance. Sounded like something like he'd gotten his MBA and PhD at University of Chicago. We'll see if they execute on this. I really hope that they do. So obviously they have a different short-term problem than we have. They have much stronger growth, but similar long-term problems with respect to the labor market and aging population. And they have a very different base for growth. It's almost all external. They only have 35% of GDP coming from domestic consumption. In the US, it's double that. Now, they want to try to make the transition to more domestic consumption, which I think is a good thing, given that Europe is best going to be a zero, US sliding along. But how are they going to do that? And I think that what they really need to do is develop a middle class. The way you develop a middle class is by making sure that that people who are rising up, who are coming in from the rural areas into the urban areas, and they've seen just an astonishing movement of hundreds of millions of people, with still hundreds of millions more to go over the next decade or so, to come into the middle class, the consumption class. Now, how did we do this after the Great Depression and World War II? It was through the provision of sensible consumer credit, through having people be able to access credit, through entrepreneurs being able to get credit, small and medium-sized enterprise get credit. Right now, China doesn't have that. They have large banks that lend to the state-owned enterprises, and there's very heavy regulation of interest rates, but they're starting to learn a few things from how we did things in the 90s and 2000s in the US. Maybe not all the best lessons. If there's money to be made, we'll try to get around some of the regulations, and that's exactly what's happening now. There's a very rapid growth of a so-called shadow banking sector because people want higher yields than 2 or 3%, because there's a very high return on capital, but they're restricted in what they can get on their savings. So very low returns there. So there are new products coming out that are being offered by the banks, that the banks are offering to their high income and their wealthy clients, that are then going and making direct loans in the property market and elsewhere. But this is exactly parallel to what happened with the shadow banking system in the US. And I think there are frightening parallels to what happened in the US. And I urge the people we met with to really look at this very carefully. Now, it may seem like I have a bit of a contradiction that you've got these new institutions coming in, and I said we need new institutions, but you need to have sustainable credit growth. We need to have what we had in the 50s and 60s in the US to really get the middle class consuming and growing, not the kinds of very highly leveraged transactions where people were not having proper disclosure, not proper risk analysis coming in, and I fear that some of that is going on in China now. So developing sustainable credit for strong growth of the middle class is necessary to make that transition. Without an infrastructure, China is not going to be able to make the transition smoothly from an international focused economy to a domestic economy. So I've now spoken about some doomsday scenarios, some apocalyptic scenarios, but also some potential positives. And so you might want to know, well, what am I going to be doing on December 21st? And 16 days, 14 hours, and now 21 minutes from now. I hope to be having a nice candlelit dinner with my partner at home. But just in case, I'm going to have about 100 candles, 500 packets of mac and cheese, 1,000 gallons of water, and a few bags of gold coins. One should always be prepared. But I hope and predict we will all be here next year. Thank you very much.